Hello everyone, and welcome to the first panel today in the webinar series. My name is Natalia Gandophi. I'm the coffee market analyst here at HedgePoint Global Markets, and I will kick off the coffee market segment. Following my presentation, we'll hear from Carlos Costa, the co-head of global sales here at HedgePoint. Our presentation today will be divided into 4 sections, starting with a 2021 wrap-up before moving into the 2022 outlook. Then we will present a brief exercise regarding the 22-23 balance and move on to the conclusion of the first part in the coffee segment. First, let's do a brief recap of events in 2021 that were relevant for prices in New York. So, back in January, the market was aware that the 21-22 crop potential had been capped by the drought, but the extent of the damage was unknown and consequently not priced in. Then, in May, when the harvest began, the damage became better known, and prices started to adjust to reflect that expected tightness in the S&D. Right after that, came the winter here in Brazil, and we had the first frosts on June 30th and July 1st, hitting 0.9% and 4.5% of Arabica production in each event. The third frost happened a little later on July 20th, hitting 8.7% of the Arabica crop, and even though the extent of the damage was smaller than previously anticipated, the 22-23 crop was now damaged as well, and prices increased in the following months to reflect that. A few months later, in November, a new La Niña event was just arriving, and with that, harvest in Colombia and Vietnam was delayed from heavy rains. And last in this recap, we have the supply from Central America, especially Honduras, flowing into the market, and alongside funds rebalancing expectations, subduing the market. So, in 2021, this is how the global coffee balance looked like. We had a 4.9 million bags deficit expected for the 21-22 cycle, accounting for the off year in Brazil and some of the damage of the drought. So, the data regarding weather in Brazil became better consolidated with time, and in addition to what we already had seen before, there was further damage as well. And regarding Arabica production, here we have the rainfall anomaly by share of production. So, December 2020, 88% of production stayed below 60% of normal rains, which are the orange, yellow, and gray columns. In October, the figure increased to 98%, and in November, it was 87%. There was a brief moment of relief in December, and in January, the share went back to 98%. So at this point, we had a crop suffering from low water resources during flowering, cherry growth, and development, which would be later translated into a tighter S&D. The second point, which only became better seen at the end of development, was the poor weather over North Colombia areas for the 21-22 crop. Here on the left, we have the share that each region makes up in total, and in the middle, we have the rainfall anomaly between June 1st and July 21st. And then on the right, rainfall anomaly between August 1st to August 28th. Throughout that whole period, which is key for the development of the October crop, these problem areas received little to no rainfall, which threatened roughly 12% of the country's crop. And the third adjustment in terms of a tighter S&D came from the side of demand. Throughout 2021, we saw imports recovering from pandemic levels, and at the same time, we saw stocks decreasing. Now, even though we are considering association stocks, which are visible stocks, there are also non-visible stocks, but we take them as a proxy for the total. And this analysis suggests that coffee demand was able to better recover during 2021. Given the issues on the supply side, we adjusted total production down from 168 to 166 million bags, and demand prompted an adjustment from 173 to 175 million bags, which led the balance from a negative 4.9 million bags to negative 8.7 million bags, the most expressive deficit in the past 10 years for total coffee. Now, moving on to the perspective surrounding the 21-23 crop, we need to consider four main factors. The first one regards washed Arabicas, represented by Colombia, Peru, and Central America. The second one relates to Robusta, here characterized by Vietnam. And the last one on the side of supply, but definitely not the least, is Brazil, representing natural Arabicas. On the side of demand, we have the United States, the European Union, and Japan, as well as a brief look at Brazil as a consumer, given its importance. So, first, when talking about milds, it is important to consider first the effect of the pandemic. The chart on the left shows New York Arabica versus differentials since mid-2019, and as we can see, differentials were the first ones to respond, as they often do, to the bottlenecks created by the pandemic. Following that increase in early 2020, differentials have generally kept their record values, despite a slight decrease from mid-2021 onwards for Central America origins and Peru. When it comes to Colombia, levels remained high, even with New York increasing by roughly 90% throughout 2021. This dynamic, and what will also shape differentials moving forward, is explained by the stock-to-use ratio we see on the right. The SU ratio, which measures ending stocks against total demand, suggests that the situation will become tighter across all mild origins by the end of the 21-22 cycle, which supports differentials at higher levels, especially for Colombia. The crop failure, alongside higher local consumption in the country, is expected to deplete stocks. Therefore, we see differentials holding record values. As a direct result from that, we see certified stocks becoming more depleted by the minute, with pending grading below what would be necessary to replenish those stocks. The chart on the left shows seasonal certified Arabica stocks, and the chart on the right shows the daily pending grading for New York Arabica, highlighting origins during massive grading periods. Well, it's a conundrum because either New York rises to meet differentials in these origins and to allow for certified stocks to increase again, or this becomes a bullish factor and possibly fuels prices in itself. Moving to the second factor, we have Robusta with Vietnam. The chart on the left shows Vietnam exports up until December and the estimates for the remainder of the 21-22 cycle. As we can see, exports are supported when compared to last year due to higher production in 21-22 and the expectation of logistics improving in Southeast Asia as the year progresses. And this dynamic is fundamentally related to how differentials have responded. For the past months, as logistics deteriorated, so have differentials in Southeast Asia to offset higher costs, which can be seen both in the central and right charts, with differentials and the freight index respectively. Freights from Asia to the US have been higher than the global average since before the pandemic, but this route saw prices increasing by nearly 800% by mid-2021, whereas the global index increased by 500%. Currently, the situation is expected to start improving by mid-2022, although a full recovery is only projected in the long run, as the order book from 2020 and 2021 starts to enter the active fleet. Also, on the side of supply, we have Brazil. As we've explored in the beginning of the presentation, Brazil is a unique case because it is already coming from a 21-22 crop failure and it is walking into another one. Still, the main question is, what are the impacts of this crop failure to trade flow and consequently prices? On the left chart, we have Brazilian exports into December and our estimates for the remainder of the 21-22 crop. Just an observation, I said December, but it's actually January. We have the latest data from Secafé until January and the estimates from February onwards. With lower output and logistic issues, exports are more likely to fall below average, especially in the off-season. With this limited availability, it would lend strength to differentials. The right chart shows FOB differentials for screen 17-18 fine cup. Differentials dropped heavily following the BRL at the beginning of the pandemic, which allowed for Brazilian coffee to be graded in certified stocks. And in this drop, it reached negative 20 cents per pound. Still, differentials have recovered to reflect the scenario of lower availability. Of course, higher New York levels could depress differentials, especially locally, but as is, differentials are being supported. Going further into the Brazilian off-season, let's discuss what it might look like. First, in terms of ending stocks, the chart on the left shows gross ending stocks from the 9-10 cycle to our expectations for 22-23. As we can see, the 2 consecutive crop failures are expected to negatively impact ending stocks, and as they fall from 2021's record to the lowest levels in a decade. When we look at it from the monthly perspective, we have the chart on the right. So, starting in April 2020 and going with estimates until July 2022, we see monthly ending stocks in this off-season below last year's levels. The orange series represents exports projected seasonally, demand in yellow projected constant, a rough estimate of the harvest based on last year's pattern in lilac, and then ending stocks for each month are the purple dots. It becomes an even more interesting case when we see the possibility that from 22-23's crop failure and the lack of carryover stocks, as the next cycle won't be able to count on 2021's records, total availability mid-harvest may be lower than in the previous year. So this is something to keep on the radar. However, not everything is a bullish case for coffee, and we need to consider all elements that may change the S&D in the coming months. In this sense, we highlight Brazilian demand. This chart shows in the orange line the change in the share of coffee within a basic basket of goods in Brazil in terms of prices. In 2021, coffee prices increased more than the basic basket of goods, leading to this hike. In the violet line, we have the purchasing power of minimum wage in Brazil, which has been in a downward trend since 2018, indeed. But in 2021 took its sharpest turn down, which can be seen in the purple column, meaning that the minimum wage lost 10% of purchasing power in terms of the number of basket of goods that can be acquired by one person. This means that not only people can buy less with their wages, but coffee has become more expensive in relative terms when compared to basic food items, such as rice or beans. Well, even in a developed country, this would be a problem. And in Brazil, where over 4 million people were launched into extreme poverty during the pandemic, this is even more relevant. And when we discuss effects over coffee, not just demand specifically, but prices overall, we need to consider macroeconomics in its entirety. The chart on the left shows the DXY in the violet line, the Fed funds target rate in the purple line, and the Bloomberg Commodity Index in the gray line. As we can see, stronger rates mean a stronger DXY when the market anticipates a hike, and a stronger DXY correlates negatively to commodity prices as a whole, not just coffee. This is important because the market expects Fed to increase rates in the next March meeting, which would boost the DXY. However, we need to consider a few other things. The chart on the right shows the 10-year US yields, the 5-year US break-even rate, and the Bloomberg Commodity Index. So, the relationship is evident, as higher inflation expectations ask for higher yields in order to clamp down on that pressure, and commodities, as well as other assets with intrinsic value, are appreciated during inflationary periods, because they are tools to hedge against inflation. What makes this period especially good for commodities is the fact that US yields have been deteriorated by inflation. The chart on the left shows the 10-year rate in violet, the CPI in purple, and the real 10-year rate in orange. The current real rate is the lowest since the oil crisis in the 70s, due to Fed's decision to zero rates during the pandemic and the inflation caused by the subsequent bottlenecks. The chart on the center shows the relationship between the real rates and commodity prices, meaning that higher real rates depreciate commodity prices. So, as we discussed previously, the market expects Fed to raise interest rates. This would be supportive of real rates. However, when it comes to the CPI, the inflationary pressures are not only derived from the monetary policy, but from the pandemic bottlenecks themselves. So, we have the chart on the right showing the current supply chain pressure, suggesting that this inflationary scenario might not be over with Fed's efforts by themselves, adding another element of uncertainty in the mix. Now, we move on to the fourth factor, destinations. The chart on the left shows destination stocks from Europe, United States, and Japan as ECF, GCA, and JCA, respectively. As we can see, stocks are in a downward trend, with even European stocks decreasing in 2021, despite being very comfortable in 2020. The chart on the right shows these three measures together and two estimates moving forward. The estimate based on seasonality considers only regular imports and stocks patterns. So during a regular year, this would be expected. However, we are not in a regular year, so the purple dotted line shows what stocks may look like when considering vegetative growth for demand alongside weaker imports, since availability is expected to decrease by the end of the 21-22 cycle. We also bring USDA stock-to-use ratio in destinations, showing that the agency expects the market to tighten this year, reaching levels similar to 8-9 years ago. Reaching the end of our presentation, we couldn't go without mentioning weather. Currently, we have an active La Niña period, which is expected to remain until springtime in the Northern Hemisphere. The chart on the left shows this in terms of the Oceanic Niño Index. And the chart on the right shows what temperature deviation usually looks like during a La Niña event during March, April, and May. La Niña causes cool and dry weather over the Pacific, which leads to fewer hurricanes over the west coast of Mexico and southwest US, but also leads to more hurricanes over Central America, due to weaker wind shear, trade winds, and less atmospheric stability. And we all have Eta and Iota still in our memory, so this is something to track. Another important point, of course, is that La Niña leads to lower temperatures in Brazil, which could increase frost likelihood. And to the market's concern, at least regarding Central America, the weather forecast for the 3-month period between March and May currently confirms these expectations. The map on the left shows the temperature anomaly forecast, colder, over the Pacific, and the map on the right shows the precipitation anomaly forecast, drier, over the Pacific, just as we saw for a regular La Niña period. So, despite not being an immediate concern, when we talk about a 2022 outlook, this should remain on the radar. Still, differently from the case for centrals, the current long-term forecast suggests that temperatures might be higher than normal in Brazil, at least until May. But it's important to note that these long-term models are subject to a lot of volatility. For now, we expect Brazilian production in 2022-23 at 37.9 million bags, which is an important revision from our previous number, since the good flowering seen in October and November 2021 did not set well, and a portion of production was lost due to this issue related to historically heavy rains in October, coupled with the previous issues that we've discussed, drought and frosts. Although quality should not be a problem this year, given that it doesn't rain during the harvest. As for Robusta, the setting proved to not be standard across regions, and we see no production growth for 22-23 at 22.3 million bags. So, All things considered, for the 22-23 perspective, the balance still depends heavily on October group development, which will only be in the second quarter of 2022. It will begin in the second quarter of 2022. So we trace some scenarios. The first one considers above average production growth and weaker demand than we originally expect. This could turn the S&D positive, although still limited at 3.9 million bags versus our current minus 2.4 million bags. However, there is a more likely possibility, which would be the 22-23 crop development turning out poorly for October group countries and demand slightly higher than we currently expect. This means that the S&D could turn even more negative, from 2.4 million bags deficit to 6.2 million bags deficit, which would tighten stocks further. So, putting together everything that we saw in today's presentation, let's look at the points based on a bullish and bearish perspective, both for New York and local prices in Brazil. On the bullish side, the 22-23 Brazilian crop will falter just as 21-22 due to drought during the vegetative stage and 3 frost events in 2021. Lower yields are expected across the board. 2 sequential deficits for global production, especially coming from Arabica, will lead to a decrease in stocks. Also, with higher expected demand, a tighter stock-to-use ratio both in origins and destinations. With New York as it is, differentials will remain high, and consequently, fewer certified stocks will be up for grading, especially with currently higher costs due to inflation. Either New York rises to capture that and allow for more certification, or differentials will remain strengthened, and the market seems to be becoming accustomed to lower stocks. So this is something to remain on the radar. Although the BRL rate is uncertain with an election year in Brazil, polarized disputes usually lead to more volatility and in the depreciation of the Brazilian currency. Although this is, of course, bearish for New York itself, it could provide support for local prices in Brazil, since we have a lack of availability for exports plus local consumption and a possibly higher New York providing support for these local prices. However, with a possibly higher New York given the S&D situation, this could depress local differentials as well. Lack of short-term resolution for logistical issues has already provided support to prices and FOB CIF differentials, which should remain for the better part of 2022. Now, on the bearish side, higher crop than previously expected for Honduras in 21-22 may put a lid on local differentials. European destination stocks, despite the downward trend, are still comfortable when compared to previous years. Given the share that the bloc takes in total coffee demand, roughly 25%, this has offset some of the optimism recently. Demand growth is still uncertain as it relates directly to economic activity and purchasing power. This point is increasingly important as the regions with higher growth rates for coffee demand are developing economies. Also, commodities across the board have received support from low benchmark rates, especially in the United States, with a consequently lower DXY. Further support came from high inflation and negative rates. Still, the macro perspective is subject to several sources of volatility, and changes in risk perception may lead to corrections in commodities markets. Given that the 22-23 October crop for October group countries is not yet defined, a particularly good year could turn the S&D positive, although this is a low likelihood scenario. All right, everyone. This was the first part of our coffee market outlook segment. I will now call Carlos Costa. Thank you all.
So thank you, Natalia, for your inputs. And now we're going to take a little look more in deep on the fundamentals and what we might expect for the market and some specifics. So moving forward here, the coffee story, we know the coffee story as an extremely volatile market that is deeply dependent on weather conditions as many other factors. This time is no different as we are experiencing a big reduction in coffee availability, what can be seen as support in coffee prices. Besides weather, we have also seen consumption growing steady in the last years with a special focus on Robusta, where we had a growth of 45% and Arabica growing 20% in the last 10 years. On the production side, Robusta experienced a growth of 40% and Arabica at 20%. So only by seeing the consumption and not considering any supply disruption related to weather, the market needed an increase in production just to be able to handle the increase in consumption. The reflection of the disruption in supplies due to weather and other conditions, plus the increase in consumption, have been placed the stocks in the lowest levels in years. The market reaction is being observed in the last year and so, but have we been get used to lower stock levels as we see in the charts here? Arabica and Robusta markets depends on each other as the industry today understood better the shifts of the roast and ground blends. So even with lower Robusta stocks in the last years, these have been curbed by Arabica supplies. The situation now become more complicated as we are with lower Robusta and also Arabica stocks. Looking specifically at Arabica miles availability, the situation seems to get even worse as we are today in the lowest historical levels of both stocks and the stock per use ratio, with a deep effect also in the Arabica certified stocks. So origins might be in a difficult situation, but we are also seeing this in destinations. Logistics problems and the current pace of demand have also been reducing availability in destinations, and with the current consumption pace, we might see stocks get even lower in months ahead. Productivity has been growing in all major origins, as we can see Colombia and Brazil showing double-digit growth in the last 10 years. But the situation remains the same, as weather can disrupt productivity, as we saw in Brazil last year due to drought. All those factors together have reduced the availability, and per our models, we might expect a tightness market on the physical side, both in stocks and also in the trade flow by third quarter of 2022. Moving to Brazil, the internal roast and ground market has seen Arabica availability decreasing, but as we said before, Conilon have curbed the decrease in Arabica lower quality supplies. So we can basically say that Conilons are now helping a lot the industry in Brazil to supply the roast and ground sector. Besides that, the reduction in the Arabica production has not only affected the amount of low-quality Arabicas that serve the local industry, but also more high-quality coffee, as we can see in the chart with the 17 upstream supplies also being drawing down and at levels we don't see since 2017. As we saw before, the Kernels in Brazil are helping supply the local industry with coffee, and we could think the situation for this type of coffee could be more comfortable. Instead of that, with a growing demand for roast and ground and a steady growth in consumption and past weather problems, we also have a delicate situation with the stock per use ratio in the lower levels historically. The ultimate reflection is in the price, with the Arabica being negotiated in the internal market at the highest levels in history. At current prices, we could have more Arabicas being replaced by Conilons. What we understand is happening. But the lack of Arabica in the internal market has been so big that even understanding the industry is replacing Arabicas to more Conilons in the blend, the spread between the two qualities that industry buys just increase. What says to us the reduction in Arabica current supplies is a reality. So for 22-23 calendar year, we expect that the supply-demand balance for the internal market and for the roast and ground industry might have a little surplus, but mainly because of the supplies the industry will have from the Kernel. The USD BRL cannot be forgotten as a big factor for market prices. Historically, New York and USD BRL correlation is negative by 37%. Then that means that 37% of the time we have USD moving up, New York price moves in the opposite direction. Since 2020, this correlation has become positive. And with current S&D situation, this correlation might continue this way, with New York have a life of his own and not being affected so much by the USD BRL movements. On the other hand, it's also important to say that for Brazil internal market, USD BRL have impacted farmers' inputs costs, what also might brought pressure for the coffee prices as well. So we expect exports for Brazil this year to decrease due to many factors we have explained before in this presentation. But what we also understand is not only the lack of availability is driving exports down, but also the competition with the local industry that needs to come and pay those prices, high prices, to keep the coffee in Brazil. We also need to remember that 2021 decrease in production made exporters to enter in the current year with a lower short book, what also helps to explain the decrease in exports. Dealers and importers have been increasing their bids in FOB markets, but we still don't see those participants in a rush to get too long down the curve. Instead, differential bids continue to see a bit above from historicals, and exporters reporting business happening for prompt shipments and then paying the price to take the coffee out of Brazil. Now, the only thing we believe could refrain market to keep the bullish movement is the inflation that is being seen in all the commodity markets. In Brazil especially, together with an increase in coffee prices, we see Brazilians' purchasing power decreasing by 10% in 2021, and coffee price participation in the basic basket of goods almost doubling from 2020 to 2021. So we understand that a decrease in demand might happen with current market situation, but especially in Brazil, due to the factors we have mentioned. In the end, the market reaction to all of those factors have been pressure not only prices in New York, but also the spreads. With New York that was trading with a contango to now trade with inverted spreads, meaning the forwards trading at lower levels than in the front months. So talking about bullish and bearish factors, on the bullish side, we understand that market might continue its upward movement as the S&D situation gets tight, especially at origins. As destination face even more reduction in their stocks, we might see differential at origins also support by demand. Spreads in New York might be even more inverted, mainly in the third quarter and fourth quarter, when we will see the worst numbers in the global trade flow. In the cash markets, coffee prices might renew the highs as the supply gets scarce. Attention needs to be paid now to the end of the crop development in Brazil that will determine not only the entire crop size, but also quality and screens. Commodities for now continue to be seen as an investment opportunity from speculators. On the bearish side, inflation might start to trigger reduction in consumption, starting in Brazil, that is seeing prices at higher levels historically. A stall in local prices in Brazil for low grades Arabicas could be an indicator that demand could be starting to decelerate. At destinations, At destinations, we don't see a decrease in demand. However, as inflation is being noted in the majority of commodities, we could see also a decrease in demand. Especially here in this point, we need to understand that, as we saw in the presentation before, we see the prices in Brazil trading at the highest levels historically. So we saw the market trading at the current levels in the last 10 years or so. So we understand that a decrease in demand might start in Brazil to then go over to other destinations and countries. Reduction in Brazilian exports could increase local stocks and lower reposition differentials. Additional spikes in USD BRL currency could also refrain new highs in New York USD term price. Interest rate increase in major economies could shift speculators' interest from commodities to financial assets. So this is basically what we have presented today. It's a brief example on how we handle a day-to-day business meeting with our customers and how we try to bring all this information together to the customer's reality. We have enough experience and understanding of the coffee market value chain as we serve from farmers to roasters. And by knowing our customers and linking those informations, we can assist the market participants on the best approach on how to manage risks. Thank you.
All right, everyone. Now we will be taking some questions. We are in the Q&A section, so feel free to send some questions our way. And I see that during the presentation we already got some, so let's begin. The first question is going to go to Carlos. Carlos, the Brazilian real has strengthened against the dollar index recently, but the future curve shows expectations that it will weaken again. How can farmers protect themselves against this?
Hello, Natalia. I think a Brazilian real more weakened, it's better for producers, in fact. So if the dollar starts to rise again, will benefit the producers. I think the most important question now is the producers are looking now with the current movement we saw in the BRL to lock prices in the future. We're not seeing that. I mean, the movement, the real movement was so huge in the last, 30 days that we don't see demand for producers to lock on those prices right now.
Right. Now let's go to the next question. This one I can take. Regarding tighter stocks, will Brazil come back to certified Arabica stocks? Right. This is a very interesting question, and it happens to touch on several subjects within coffee fundamentals because it relates to Brazilian output, the BRL, logistics, and demand, especially in destinations. If I'm not mistaken, we had Brazil grading almost 2,000 bags yesterday, and there are roughly 90,000 bags to be graded as well from various origins, but that hardly touches the surface when it comes to the drawback that we've seen in the past months. When we look to the 22-23 crop potential to be graded, quality has been reported as very, very positive, provided, of course, that it doesn't rain during the harvest. However, we are talking about 2 consecutive deficits in 21-22 and 22-23, which leaves, of course, less room for gradings. And another factor is that semi-washed differentials are currently at -4 cents per pound, with further potential up, which does not make grading attractive. And logistics are making it harder to source coffee. So in terms of quality, there is potential, yes, but in other fronts, there is less likelihood. And at the end of the day, it's something that we've discussed here today. Could the market be adjusting to lower stocks overall? And when it comes to certified Arabica stocks, especially, could traditional origins return? Because so far they are even more far off in terms of differentials than Brazil. So that throws another pinch of uncertainty in this dynamic. So let's see our questions. Carlos, another one for you. What happens to spreads if speculators start to adjust positions and sell?
Well, the question is why speculators would sell right now if for them they're holding a long position, the spreads is paying for them to hold this type of positions. So I don't think right now the specs will sell. The supply and demand balance sheet is extremely tight, and we are seeing that being reflected on the spreads. So I truly don't believe that might happen now. Maybe after the Brazilian harvest and the forecast for Brazilian harvest in 2023, after the flowering, after the rains in the second semester, we might see speculators starting to adjust some of the positions. But I don't see that happening right now. Another thing that needs to be taken into the account is the interest rate increase, especially in the US. That might take some of the punch of the speculators from commodities to a more financial asset type of buying type of position. So I don't see spec selling right now, to be honest.
Right. We've got another couple of questions. If anybody has any other questions, please feel free to click on the question mark at the right side of the screen and send us some questions. We have a couple more to go through. So this one, I would take it. Roasters are already passing costs to the final consumer. What effect could this have on demand? Well, this is also a very interesting question since coffee has a number of intricate attributes, and some argue that coffee demand is price inelastic, which means that people buy coffee at any price, but that's not true for every market and not true for every situation. If we look back, when prices reached historical highs back in 10-11, those costs were transferred from roasters to end consumers, and we've seen actually some destruction of demand. In that cycle, demand decreased by roughly 2.7%. And of course, coffee consumption has evolved so much since, with a total demand increasing by nearly a quarter of what it was 10 years ago, because these changes happened by other reasons beyond economic and population growth, since coffee became a cultural staple and has started to gain traction in countries that did not consume it at all. The issue is that this time around, there are two different measures going on. The first one would be related to the fact that, especially in traditional markets, which are developed economies, the personal savings rate skyrocketed when the pandemic broke out, very differently from the last time such a price increase happened. On the other hand, inflation is a much more prevalent issue now. And as we saw in Brazil's example, purchasing power has been corroded. Wages have not kept up with inflation. And in this particular scenario of wages not being adjusted to inflation and purchasing power being lost, final demand encounters a bearish aspect. However, of course, this is not true for every country and is definitely a bigger threat for developing economies, which are not the biggest consumers, but are driving the largest growth rates for coffee consumption. So the concerns actually stem from that.
Can I add something on that? Can I add something on that, Natalia? I think this is a very important topic. The only place we are seeing coffee prices on historical highs, never saw prices at these levels, is in Brazil right now. I mean, we saw coffee prices trading at 250 per pound. I mean, 10 years ago, but the consumption was not corroded or even we didn't saw a decrease, because in dollar terms, in USD dollar terms, we saw coffee prices at these levels that we are seeing now. Now, in Brazil, the story is different. The prices in BRL are in, I mean, we never saw those prices at those levels that we're seeing now. So if we have a decrease on demand, that might start, in my opinion, that might start, especially in Brazil. And we saw that with the numbers. I mean, the purchase power of Brazilians went down 10% last year. And the price of the coffee inside of the consumer good basket, I mean, almost double. So Brazil is a very special case. We consume a lot of coffee here. So if we start to see a decrease in demand, that might start to happen here in Brazil. That's my view.
Right. We have another question. What is expected for local prices in Brazil and differentials? Carlos, you can take this one.
Well, as I said, the situation in Brazil is very particular. One of the things that is happening here is that the industry, the roast and ground industry in Brazil, is facing a big challenge to originate coffee for their factories. Okay, so one of the things that I've realized in the past few weeks is actually the industry is forming prices not only for low-grade Arabicas and also Kernels, but also for the exports. Because when you have an industry paying like 1,400 reais for a low-grade Arabica, that will also reflect on the high-grade Arabicas, you know? So my point is, as the demand in Brazil is still strong, we're not seeing demand coming off. I do believe that the market will still continue on a bullish trend, mainly for the low-grade Arabicas in Brazil, and that will have a reflection on the high-grade Arabicas and also in the export prices. So, in a nutshell, importers and dealers will have to pay more to take coffee out of Brazil, and the main competitors from them is the local industry. Even though they don't buy the same coffee, the fact that they are paying more to originate coffee to keep their factories open and running will dictate prices on the FOB side as well.
Right, thanks, Carlos. We have time for one last question. So let's see. What is the perspective for Arabica exports other than Brazil, like Colombia and Central America? Right, so as we approach March, this question increases in importance since we're getting close to peak exports for these two regions between March and May. Both for Central America and Colombia, a small recovery is expected against 2021 and 1920. But exports are not expected to rise above average this year. Colombia faces lower output this year, and although Centrals are expected to see production a little higher than previously anticipated, levels are still far off from the highs in 1718 and 1819, when exports rose above 15 million bags. This is one of the reasons behind strong differentials, since despite the increase in New York, Colombia still holds a 60 cents per pound premium, Honduras almost 25, and Nicaragua as well. But perhaps more importantly than exports themselves are the ending stocks, which, as we've explored, will be tighter by the end of the 21-22 cycle. Right, so that's about it for the time that we had for questions. At the end of the presentation, we will display a QR code there it is. And feel free to send questions our way, and we'll reply to them later by email.